Adding to the nerves in the share and bond markets worldwide is the current standoff between the Democrats and the Republicans about the US's $31.4 trillion debt ceiling. Ratings agency Fitch put the US credit ratings on a negative bias, and Treasury Secretary Janet Yellen warned that time and money is running out.
Highly likely that we would run out of resources to meet all the government's obligations in early June, and possibly as early as June 1st. We no longer see very much likelihood that our resources will enable us to get to the middle or end of June.
Well, this week I caught up with Adam Creighton, Washington correspondent for the Australian newspaper and a contributor here on Sky News, and asked him about the prospect of a default.
Well, certainly, Ross, there's never been a technical default by the US, at least since 1979, so we don't actually know what the ramifications would be, although certainly they would be pretty scary. It came pretty close in 2011 and then in 2013 during the Obama administration. But, I mean, look, I think we can be pretty safe that there is going to be some sort of agreement, but it wouldn't surprise me if it does go right up to the wire. The Treasury Secretary, Janet Yellen, as you know, she said 1st of June is the first day that the US could actually default if they don't increase the debt ceiling, although it's probably fair to say it's sometime after that. There's a lot of economists saying it's more likely to be 2 weeks from that point, the middle of June sometime, but it is very difficult to know because the revenue coming into the US government is somewhat lumpy and it's unpredictable, and the same can be said for the outgoings as well. But look, at the end of the day, this is a political game, as much as an economic game, and both of the two major parties here essentially want to win the political debate. And that's kind of where we're at the moment. President Biden doesn't really want to be seen to be backing down to Republican demands. And on the other side of the equation, the Republicans, they're pretty insistent on this idea that spending has to go back to 2022 levels, which is the spending level of last year, but that's a pretty significant cut.
OK, so this debt ceiling, $31.4 trillion, which everybody recognises is a big sum, but then so too is the US economy itself. So relative to the US economy, how does it relate? Because when you get a fast-growing economy, of course, it can absorb more debt.
Well, look, if you go back to 2011 that I just mentioned before, the debt ceiling was about $14 trillion. So you can see the US has a serious debt problem. It's more than doubled, basically, in a little over 10 years. So the Republicans are correct that there is a serious problem here, and there does have to be one of two things happen. There needs to be spending cuts, major spending cuts, or there needs to be significant tax increases. So as one of those two things has to happen. Basically, the US budget deficit each year at the moment is about $1.5 trillion. Which is just huge. I mean, the budget deficit here as a share of GDP is about 5 percentage points, which is just absolutely enormous when you think about it. And the jobless rate, of course, is at record lows, 3.5% roughly. So you've got an economy that is very robust at the moment, that is very resilient, you'd have to say. But at the same time, massive budget deficit. So something's going to have to give.
So Janet Yellen and others have warned of recession in the United States if they don't come to an agreement quickly. But then the United States, let's be honest, has been teetering on the edge of recession for the past 6 months or so.
Yeah, look, it's fair to say the US economy's been very resilient. People have been saying it's going to fall into recession now for about a year. We've had these very rapid increases in interest rates, and they don't seem to have slowed down the US economy yet. The jobs figures continue to surprise on the upside, more or less. That's not to say that suddenly the huge increase in rates won't be a factor, but it hasn't been yet. Look, my personal view is that if there is a default, it's still highly unlikely, although there was a JP Morgan note out this week saying that they put the chance at about 25% now of some sort of technical default, at least for a day or two. That could prompt a different set of circumstances. But it's probably going to lead to a fall in the stock market, a small bump in interest rates, which is not great, of course. But the forecasts of a Great Depression and 10 million people out of work, I think that's hyperbole.
And the more grave fear, having heard Jamie Dimon speak this week from JP Morgan Chase, the biggest bank in America, warning about not only higher interest rates in the future, but then also warning about the lack of availability of credit. A credit squeeze under these circumstances, especially with the government potentially going to default, that could be the worst of all circumstances, not just for the US economy, but for the global economy as well.
Yeah, look, certainly if that's right, there could be a credit squeeze. I mean, it's very unpredictable at the moment. Like I say, you've had these huge increases in rates. They don't seem to have had an effect yet. I mean, the mortgage structure here, the housing market, of course, is structured very differently from back home. But it's certainly true, as you suggest, that if there's a recession here, if there's a major downturn, that's of course going to affect Australian households very much, and mainly through the value of their superannuation balances, of course, because the stock market will fall at least in the short term and maybe in the medium term too. So look, I think it's. We all want them to reach an agreement, and soon. And if they do, you'll probably see a big bounce in the stock market, I think.
It's going to be interesting to watch it. Adam Creighton, always good to chat to you in Washington. Many thanks for your time today.
Thanks, Ross.